Pfizer's down 18% over the last year, and it had a $59 peak during COVID. But this hated stock is suddenly looking like an obesity bargain, thanks to its agreement to buy Metsera for $7.3 billion. Metsera has assembled a portfolio of weight loss drugs designed for patients to take less than today's current leaders in the GLP-1 drug class. Let's unvault a 1-minute discounted cash flow analysis of Pfizer to see if this is a value trap or a value investment. Pfizer is a global pharma giant. In 2022, had a record $100 billion in revenue during the COVID vaccines, but revenue is down 42% to $58.5 billion as COVID demand collapsed, and it settled into the new normal of $62 billion revenue. Has a crazy dividend of almost 7%. Strengths, the moat, scale, global distribution, R&D engine, 9 FDA approvals in 23. New launches: RSV vaccine, a migraine drug, Nurtec, and ulcerative colitis drug, Velsipity. Who names these drugs? Weakness is its heavy dependence on acquisitions. It's not able to profitably reinvest in its own core business. And that's shown by a pathetic 5% return on invested capital, my favorite metric. And that makes margins volatile from 38% EBIT in 22 to 1% in 23 to 15% in 24. And it takes debt to make all these acquisitions. The C-Gen equals $43 billion. Debt doubled to $65 billion. It's manageable, but leverage is high compared to peers. But it has a growth story. Pipeline bets: oncology, C-Gen, antibody, drug, conjugates, obesity, Metsera acquisition. It's an early trial, so no sales will happen until 2030. Analysts see this as a $5 billion potential if successful. Vaccines: RSV, shingles, mRNA in trials, flu, mRNA, and some rare disease assets. But it faces 2 patent cliffs in 26 and 27. And IRA drug price reforms have caused negative $1 billion hit in 25 alone. And there's pipeline risk. Metsera and others are still bets, not cash. Discounted cash flow analysis: if the revenue grows 3 to 5% post 2027 with margins in the mid-30s, EBITDA by 2030, the discount rate at 8%, and the terminal growth at 2%. Then a bull case where the pipeline's acquisitions hit, the margins are greater than 30%, then the fair value is $35 to $40. But if growth resumes slowly and margins stabilize mid-20s, the fair value is still $28 to $30. And if it's a total disaster, the fair value is $18 to $20. And in value investing, that's kind of what you want to see. You want to see an asymmetric upside, downside. Upside has a much larger return than the downside. So it looks like a buy at 24 and you get paid 7% to wait. This is not financial advice. Let me know in the comments what stock you're going to look at next.